But
Yep.
stay with us. Let's bring in Kinja Lau. He's Chief China Equity Strategist at Goldman Sachs. And from a market's perspective, I mean, we've just seen Chinese equities coming online. They're still up. What did you think about what we just heard there and how it sort of sets the scene for Chinese equities?
Right. As Stephen said, there's a lot to digest, right? But I think one thing that we've learned since 2018 is really that U.S.-China relations are multi-dimensional. Right? Talk about trade, technology, capital markets, geopolitics. So it's highly uncertain, and we'll see how the tariff risks are going to unfold. But I think one thing to flag here is that I think at the moment, the equity market is not too concerned about U.S.-China tensions at the moment. And the reason I'm saying this is that we have a proprietary indicator to help us quantify to what extent U.S.-China tensions are embedded in prevailing equity valuations. And right now, I think we're at mid-range, right? So again, suggesting that this is not the most topical or at the forefront of investor concerns. Now, when it comes to tariff, it's still our base case that the U.S. will raise tariff on China by about 20 percentage points by the end of this year. Timing is highly uncertain, but if that's the case, I think China should be able to digest that. So we think there will be some policy response from the Chinese government to soften the external headwinds, as well as trying to facilitate the economic rebalancing from external demand to domestic demand. So from a market standpoint, we're still forecasting about 20% rise in Chinese equities over the next 12 months.
And what is the assumption there on what type of earnings growth you're expecting on the, let me call it 2020, like 20% tariffs, 20% return? What is earnings growth? So
let me say this, David. Without tariff, I think we can expect sort of low teens type of earnings growth from Chinese corporates for this year, 2025. But after factoring in about 20% tariff rise in our forecast, we're now looking for about 7%, which is somewhat below consensus. So if you break down the 20% returns that we are looking at right now, is about 10% coming from multiple expansion or multiple recovery, but about 10% from earnings.
They agreed to work together on resolving TikTok. There were lots of comments from Donald Trump about TikTok, obviously, about trying to find an equitable solution, maybe a 50-50 joint venture. But on tariffs, I think we just have to kind of wait and see. But I'm sure Beijing is fairly pleased right now that they were not in the crosshairs this morning. Others perhaps were, Canada and Mexico. He talked a little bit about Europe as well. He talked about the notion of universal tariffs as well. So I think we have to kind of wait and see what the response is from Trump.
And just one thing to flag. Last week we held our annual Global Macro Conference in Hong Kong, very well attended. 1,800 people came from different parts of the world, and we did a lot of investor surveys and polling questions. And obviously, we asked investors their view about tariff, right? How much they're going to expect from the U.S. And quite interestingly, more than 50% of the respondents, they picked 20%, 10 to 20%, as their base case for potential increase on China tariff. So when we first put out our 20% sort of forecast last November, our number was perceived as very optimistic, but now it seems like market view or expectation is converging to our number.
Yeah, it's coalesced towards a lower level. Steve, yeah, go ahead.
Yeah, I think some have likened these executive orders and the fact that he did not necessarily single out China.
Well, I mean, Kinja, to your point, and to, I think, the moving parts that we still have to sort of juggle with, if you're a China bull, I mean, you're hoping 20%. I mean, you're hoping no tariffs, right? But in the event we get something higher, and who knows if we get something higher, for example, you know, one of your report highlights the fact that there is a domestic policy put that in almost all scenarios, correct me if I'm wrong, the market has found a floor, and that a bear market in China never exceeds 3 years. And was last year the third year?
Last year, what? Yes.
It was the third year there. So is the floor in, I guess, is my question there.
Right. So this is the story that we're painting. So essentially 2024 is a year where the policy put has been exercised, right? That's why putting a floor on the market. Now, in 2025, we think that we're going to transition from a policy expectation phase to more like a policy implementation stage, right? So we need actual policy implementation to support growth and then to drive earnings. That's why we think the upcoming 2 sessions in March will be important, and that's the value for us to get more clarity about policy support from the government.
And Steve, of course, you're actually going to be travelling to Beijing for us for the upcoming meetings in March. How much is what we just heard here and these first few days in office for Trump, how much is that going to also factor into the sorts of policies we get out of that as well?
Well, I think the Chinese economy has its own set of issues that they have to deal with, whether it is persistent deflation, lack of confidence from the consumer, all kinds of structural issues, the property market, the prospect of tariffs obviously is there. It's going to hurt potentially exporters, which has been the strength of the Chinese economy going into 2025. There is going to be a policy response coming out of the National People's Congress for sure. We know that because after the Central Economic Work Conference in late December, essentially they set the agenda. We won't hear the specifics, but clearly there will be a fiscal response. How much? We don't know. And what kind of steps to kind of put a floor on the property market? That's a longer structural problem, but also just consumption is going to be the theme going forward in 2025. And they can do something policy-wise.
Is that the equity play? Consumption, or are you looking at other sectors?
We like consumption as a theme. That's why we're still overweight consumer tech, internet companies, media, but it's a very broad concept, but really for investors to pick up some alpha, we think the theme of local government consumption could be interesting. Now, the logic here is that we think that that swap program is going to help improve local government's circulation, finance position. And remember that if you look at consumption as a whole, is 55% of GDP, but 1/3 of that comes from local government spending. So if the local governments, they have more money to spend, I think that will translate into better local growth backdrop. And we like sectors or stocks that are more sensitive or related to local government spending, like healthcare, F&Bs, and constructors and things like that.
How are you thinking about the yuan as well in this? I mean, we've just seen a huge sort of whipsaw off the back of it, and we had that expectation for dollar strength. We saw a little bit of weakness overnight, but what's the sort of flow-on effect then?
We're looking for some currency weakness for the RMB. So let's say if 20% comes true, then we expect the RMB dollar CNY to go to 7.5. So you're talking about another 3%, 4% potential depreciation from here.
Well, I just came back from the UBS Greater China Conference in Shanghai, and I talked to Al Gabor, who's the chairman of the American Chamber of Commerce in Shanghai. He said one of the big issues for American companies and for the Chinese economy is going to be an outsized depreciation of the yuan. What does that mean for outflows, and how does China do a policy response to balance giving competitiveness to its exporters, but at the same time not seeing those outflows?
Now, Stephen, if you look at the statement coming out from the PBOC, they're still very much emphasizing the currency stability, right? So, I mean, we're talking about a bigger problem, well, a bigger backdrop here is that the US dollar strength is quite universal, right? US dollar is appreciating against the major trading partners. So I think the currency weakness here we're forecasting should be manageable from a capital flows perspective. And I think at the same time, don't forget that the capital account is still highly managed by the Chinese authorities. So we don't think that the capital outflow problems will be that significant.
What about just to lead into the geopolitical angle a little bit more, what about some of the trades that have done extremely well in China because of geopolitics? You know, I'll just mention a specific name. You know, SMIC has effectively doubled since September. You know, these companies and sectors that might benefit if China is successful in being, you know, industrial independent, for example.
Yeah.
Do you think that trade continues, that strategy continues, or is it worth taking the profits there and putting them elsewhere?
I think you're right, David. So the self-sufficiency trend or theme has done well. But I think if you look back over the past couple of years, one of the very rewarding and alpha-generating ideas or themes in the equity market has been the shareholder returns theme.
Okay.
Right? Chinese corporates paying shareholders back via dividends and buybacks. Now, just a few numbers to put things into perspective. Last year, Chinese corporates returned more than 3 trillion RMB worth of cash back to shareholders. Again, via dividends and buybacks. And given the policy encouragement here and the relatively robust financial positions for Chinese corporates, we expect that number to go up to 3.5 trillion this year. That's record high. So I think whether we talk about uncertainty from an external perspective or domestic growth headwinds, I think that theme, shareholder returns theme, will prevail.
When does that story become sort of a negative as far as, you know, what it means for the outlook and confidence in the economy is concerned?
Right. I think we're talking about a couple of things here. Number one, we talk about excess cash, right? So right now, as Stephen mentioned, there's some problems domestically in terms of overcapacity, oversupply. So for companies in those areas, I think it's much better for them to return cash back to shareholders as opposed to investing in new capex. But obviously, in areas where growth potential is much more significant, it would be better for them to invest in the future as opposed to just paying cash back to shareholders.
Kendra, thank you so much for, well, first being patient, staying with us, of course, unexpected news coming out of DC today.